So now we're up to treasury stock. And treasury stock is probably something you haven't run into before. Basically, a company will issue some common stock on the open market. We've done that. And this is a situation where the company decides to buy back some shares of its own stock. It has to be the company's own stock. If our company bought shares of another company's stock, those shares would show up as investments in the asset section of the balance sheet. But because this is a company buying back its own shares, this is a stockholders' equity transaction. And so all of the accounting for treasury stock takes place in the stockholders' equity section, which is why we do it in this chapter. So basically, a company buys back its own stock from its stockholders. It's been out on the open market, and it's just buying it back. Now, why would a company do this? Several reasons. The main one is that a lot of companies have sort of a target range they like to keep their share price in, and so they will have sort of a permanent buyback program where they will buy treasury shares and then put them on the open market simply to really influence the supply and the demand of their stock and keep their stock price within a certain range. It also could be a good return on capital. In other words, the company might have extra money, and their stock may be low at this point, and so it's a good buy. They'll plan to buy it low and sell it high later. The other thing is they want to send, like I think a couple of the examples I give, like Walmart at one point bought 15 billion of their own shares to send a message to the market that they thought their stock was a good deal, and so maybe other people would buy it. And let's see, increasing earnings per share. Obviously, if you have, when you're computing earnings per share, you're going net income divided by the number of shares outstanding. So if you don't have as many shares outstanding, you're dividing your income by a smaller number. So that can be some rationale. The other, they could need it to distribute shares as part of employee compensation. There's a lot of companies that will, as part of compensation packages, give, shares of their stock. And then the one big reason is to avoid a hostile takeover. Shares of stock vote. And so if another firm is making a hostile move on your company, you want to get as many of those voting shares off the market as you can so that they can't, sort of do an overthrow at your annual meeting with all of their shares. So it reduces the number of voting shares outstanding. So then we have to account for treasury stock. We can retire it, which is something we don't do in this course. We can reissue it, or we can hold it as stock in our treasury, which is why they call it treasury stock. So we're going to do the journal entries for, basically buying the treasury stock off the open market and then reissuing it at either a higher or a lower price. And I think I will take those up in the next video.